All right, as we're recording. All right. So thank you so much, Megan, for being our guest for April. It is April and tax deadline in Canada is April 30th. So the topic today will be about taxes. And we have some questions from some of our members that we'll be going through. But first, before we get started, can you just give a little bit of an introduction about yourself and what you do for your clients?
Okay, so my name's Megan, like you said. I have my own financial planning practice where I work with families and specifically people with income properties or wannabe income property owners with their financial plans and their taxes so that, number one, they know that they're saving the right amount in the right types of accounts. They have a debt repayment plan if that's something that's important to them, and that they're not paying more tax than they should. So that's how I professionally work with clients. And on a personal level, I'm Canadian as well. I am a mom to 4 kiddos. And yeah, so I'm busy.
Yeah, no kidding.
Mm-hmm.
So that's amazing. And yeah, I'm always getting questions about housing and, we're in Canada and, everyone's been, especially the last couple of years, there's been a lot of talk about housing and a lot of millennials are definitely they want to eventually own a home, but some feel just in the big cities, they feel that, okay, it's kind of out of reach for them, but you're up in Thunder Bay.
In Thunder Bay, yeah. So up in Northern Ontario, yeah.
Mm-hmm. And it's a much different environment compared to, I guess, Toronto, GTA, and Vancouver, right?
It is a much different market in terms of real estate.
Mm-hmm.
We have our own struggles. So it's just the prices are not as unreachable.
Mm-hmm. Exactly. So, and it's amazing that you do taxes because it's one of our biggest bills. So of course, why not minimize it, right?
Absolutely.
So one of the questions we have for you is, what is the difference between a tax credit and tax deduction, and which one is better?
That's a really good question, and they both seem very similar. They both seem like you want as many of them as possible.
Exactly.
So
they sound good.
Yeah, they sound amazing. And one isn't better than the other. It's kind of like thinking that a sale at the store is better than a coupon, or a coupon is better than a sale at the store. They're both, money in your pocket if you take advantage of it. So the problem with tax deductions is that something normally you have to input yourself. You have to tell CRA you qualify for this tax deduction. Mm-hmm. Whereas a tax credit on the software, normally they'll ask you a question like, did you buy a home in 2017? And it'll trigger, oh, yeah, they're a candidate for this tax credit. So that's kind of what makes them different in terms of which one is better or worse. But what they are is a tax deduction. I'm going to use simple numbers so that we can kind of wrap our heads around it. A tax deduction reduces your income. So let's say you make $30,000 a year. A tax deduction that a lot of people are aware of is an RSP deposit. So you make $30,000 a year. Let's say you deposited $30,000 in your RSP. That immediately reduces your income to $0. Whereas a tax credit wouldn't reduce there aren't any $30,000 tax credits, but if there was, if you qualified for the tax credit, it doesn't impact your taxable income. So let me give another example. So that was an RSP deduction. An RSP contribution is a deduction. A tax credit is something like the first-time homebuyer's tax credit, which is a $5,000 tax credit. So if you make $5,000, but you qualify for the tax credit of $5,000 for the first-time homebuyers, it doesn't make your income zero. So that's kind of the difference. the $5,000 tax credit actually gives you $750.
Right.
So
the
that's,
deductions will increase or decrease your tax bill significantly more.
yeah. And a tax credit is like a little perk on top of it. And it's something
Right.
that you have to tell them you qualify for.
That's right. Exactly.
Mm-hmm.
That's amazing. I love that analogy. I love how you broke it down. That's like so much easier to understand. And I think a lot of people, they kind of use credits and deductions interchangeably, but there is clearly there's a difference. And I love how you broke it down. So thank you for that. So what are some of the ways, so I do get like a lot of people asking me, well, okay, people work full time, they don't have like a side hustle, so no business expenses to kind of offset their tax bill. Like, what are some of the ways for someone to reduce their tax bill, to get a bit of a refund, but mainly just overall reduce their tax bill?
Okay, so I'm going to bring us back to the credits and the deductions. So just making sure that you are aware of what you're entitled to. So if you didn't know, let's say that you live somewhere northern and you didn't know there was a northern residency deduction, CRA isn't going to come knock on your door and say, oh, by the way, Michelle, did you know you qualified for this northern residency deduction? They're not gonna tell you that.
No.
So just making sure that you're aware of all the deductions available to you. So whether that's asking people similar to your situation, if they are claiming things that maybe you should also, talking to a professional like a CPA or a CFP, all those things kind of can help you make sure you're claiming what you're entitled to. The other thing, paying tax isn't always a bad thing. So when you're paying tax, it's telling you you're making money. Okay?
Exactly.
So one of the things that I say to some of the people that kind of are in a higher income position, or people that have multiple jobs, because your job at ABC might be charging you tax for the income that you have there, but your job, XYZ, they're also charging you tax, but not at the rate of those two places combined. So what I recommend is just ask one of the places to say, can you just charge me, or can you deduct an extra $50 per pay for my taxes, because I also have another job. And so they're not taxing you enough. So it's kind of taking the two approaches of, okay, I'm going to make sure I claim all the credits and all the deductions I'm entitled to, but also you have to pay tax. So make sure you're being charged appropriately throughout the year, because $50 per pay might not feel much different to you. But getting a tax bill for $2,000 at the end of the year hurts.
That hurts. Yeah, that hurts a lot. Yeah, for sure.
I can tell a funny story here. So one year I had we took out a loan for a van. And it's funny because I'm a financial advisor, but I have the same mindset issues as everybody else, where I had the money to pay for the van, but I wanted the payments because I felt sick about seeing that balance be zero. Okay? Yep. Which doesn't make any sense numbers wise, but emotionally it made me feel good. So what I said was, the balance of my van got to be like $5,000. That's all I owed on it. And I said I was going to use my tax refund to pay off the rest of it, so that it felt free. It felt like I wasn't dipping into my own savings.
That's right.
That year I owed.
Oh no.
So it was like a double punch in the gut. It was like, I thought I was going to be debt free from this vehicle purchase, but I not only wasn't, or I would have to use my own savings, I also owed thousands of dollars.
Yes.
Which is like, I feel like anything under 1,000 sucks still, but it doesn't hurt as much. Anything that's like the 4-digit area is like,
it's true,
it has a different feel about it. So,
for sure.
Yeah.
Absolutely. No, that's great. Like it's so true. It's if you can find ways to reduce your big tax bill at the end of the year, pay a little bit more, that's like a much better strategy. Plus it doesn't, and it's true, like it doesn't hurt as much. Even though it's like the same throughout, but you know, you're better off doing that than rather than assuming that like you're gonna get a tax refund, but at least you're kind of on the safer side, because again, we always like to plan ahead and be okay, I'm expecting this and that, but we certainly don't want to, well, one, we don't want to, so two, we don't expect to be paying a tax, like a tax bill at the end of the year. So that's a really good idea. So one of the other questions we have is with regards to pensions. So some people, you know, if you're lucky enough to get like a nice pension at work, like a defined benefit plan or a defined contribution plan, some people are asking, like, should I still invest money in RSPs if they do get a pension at work? What are your thoughts around that?
My thoughts around that are, I mean, so annoying. I'm going to just throw it out there. My thoughts are, it depends, which is like everybody wants to know what the answer is. So what I say for RSPs is, number one, it will reduce your tax bill at the end in April. So that's one benefit of doing the RSPs, even if you have a pension. As long as you have the allowable room, that's one benefit of doing it that way. But the other thing to consider is that when you take money out of your RSPs, you're going to be taxed on that money. So I like the idea of even if you don't have a pension, so people with a pension and without a pension, invest in the TFSA first.
For sure.
And then go to the RSPs next. Because, like, okay, so I don't have a pension. My husband is a teacher. He has a pension. The nice thing about his job is there's a pension. He also contributes. And then you have the option to do RSPs to reduce his taxable income if he wants to. The other thing to consider is people in our age group don't tend to stay at the same place their whole careers. Which is something that sometimes pensions give you that golden handcuff where you might want to try maybe doing a side hustle, or you might get an opportunity that's really exciting that isn't like, let's talk about my husband. He's a teacher. What if he got an opportunity to do something different? He's an art teacher. What if it had to do with art and like really expanding his art something or other? Like, that's totally not my mind thing, but because I'm more of a numbers person. But let's say he got this great opportunity in the art industry. Would having the pension make him question that opportunity? Whereas if he was always contributing to an RSP, anyways, he's already in the habit of doing that. Would it kind of give him the sense of security that I'm going to take my pension from work and invest it, like take it out, not out meaning withdrawal, but like move it to my bank or credit union or advisor. And I also have my RSP. So like, I feel good about that. And I'm already in the habit of doing all those deposits.
That's right.
Would that allow him to pursue that new opportunity? Maybe. So I think there's a couple different ways to look at it. Like, you have to consider the tax consequences, the perks, and all those things, but also the mindset of maybe you wouldn't pursue something because of the pension, which,
that's right.
I mean, we only get one chance at this thing called life. So do what feels good. And there's a lot of shame and money or shame and guilt around money. So if they, by doing RSP deposits, can maybe give themselves a pat on the back, then I say do it.
For sure. I agree. And I like, I'm a strong believer in that, because RSPs, like you manage your own account, and you do you take a tax hit when you take it out. But in the end, like at the end of the day, if there's a dire situation where you need to take it out, you have that control, and it's not being withheld by your employer, because you can't dip into your pension before you retire. So at least you have that control in the event anything happens, like if it's really really bad emergency or whatever the case is, like it's there for you. So you can take it wherever you want and you have total control over that.
Absolutely.
Awesome. So the next question comes from one person. So it's like a situation. So I'm going to read this to you. So somebody approached me. She asked me, I recently got engaged, and my fiance and I are currently living together in a condo that he owns. I've never owned a property before, but because he already has a home, am I still eligible to take money out of my RSPs tax-free to be used as a down payment under the first-time home buyers plan? So she's looking to buy a new another house because they're living in a condo together, but he owns it, so he's not eligible for the first-time home buyers plan. But because they're about to get married, is she eligible to take money out tax-free?
That is a really good question. So I want to just stick true to the rules of CRA. So
always a good idea.
Yeah. Because it's important to know that even if you or your boyfriend previously owned a home, you can still be considered a first-time home buyer. So that's an important thing to know, is like, I've owned a home, but if a situation in my life changed, I could still benefit from this first-time home buyer rule. Okay. The other thing is, if her name isn't on the like the documents for this home, then she qualifies for the home. Does that make sense?
Absolutely. Yes.
Yes.
Absolutely. That's yeah, absolutely. That's the answer she was looking for, because she wasn't sure, because she thought she lives in a house that he owns and they're about to get married, so everything's kind of joint, right? Because everyone is thinking, oh, once you're married, everything's joint and you share everything, but it's not the case, right? I mean, you have individual RSPs for a reason, individual TFSAs for a reason, individual, and because that's money coming out of your individual RSPs, as an individual, you can still be eligible whether you're getting married or if you're single.
Right. So, absolutely.
All right. And the next question from another audience member. I work full-time, own a house in the city. I live upstairs and rent out the downstairs unit. And last year I bought a pre-construction condo that's still in development. I have a 6-figure salary, already have money in my RSPs and TFSAs. Besides RSPs, are there other ways I can reduce my overall tax bill?
Okay, interesting scenario. So because you have the rental property that you don't live in, making sure that you're taking advantage of all the deductions there. So maintenance, repairs, your property taxes, your interest on your mortgage, if you have a mortgage, the travel to that property to do the maintenance and repairs, if you do them. I mean, so there's, I mean, and if you have to hire out, that expense deducted, like keep track of all your receipts. Then you also are eligible to deduct the expenses for the rental on your, was it upstairs or downstairs, whatever one it was, for that unit, you can deduct those expenses. The only thing I would recommend there is there's an option to claim a non-expense cash flow expense called depreciation. So it's like this fictional number that CRA tells you you're eligible to claim, but it's not like, if they say you're eligible to claim $10,000 in depreciation, it's not a $10,000 out of your pocket, expense that you had to pay.
Mm-hmm.
He or she can claim that on their property that they're renting. I wouldn't suggest claiming it on the property that he lives in and rents up one of the units.
Mm-hmm.
Because he or she is, by claiming that depreciation on the house that he or she lives in, is saying that that's no longer a primary residence.
Oh, okay. Gotcha.
So you're 100% allowed to deduct expenses, even if it's at your principal residence, and take advantage of that tax savings when they sell the house.
Mm-hmm.
So that depreciation is kind of a good expense to have for the property that they don't live in. As long as you
Mm-hmm.
have enough depreciation, you can reduce your income on that property to zero. You
That's
can't
so good
make
to
it
know.
negative, but you can
Right.
reduce it to zero. The important caveat there is let's say over the lifetime of that house, they claimed $10,000 in depreciation over that lifetime.
Mm-hmm.
When they sell that house, CRA is going to say, we let you have that tax break, periodically throughout the life of that investment, but now we want our money back.
Mm-hmm.
So taking that into consideration on your tax bracket now and your tax bracket in the future, which is kind of like asking you to have a crystal ball, kind
Right. Exactly.
of,
What's gonna
but
happen in 10 years?
right. So just making sure that you're tracking everything, keeping your receipts for the two properties.
That's right.
Yeah.
That's awesome. That's so good to know. I didn't know that. Like I'm familiar with depreciation, but like to kind of put it into practice and use it for like in this scenario, that's really good to know. And I don't think a lot of people are very familiar with that. So it's really like it's really interesting.
And
So
the
thank you
same
for that.
and the same thing applies to self-employed people. So if you're self-employed, you can deduct your home office expenses. There's an option to claim depreciation on your house. Please
Mm-hmm.
do not do that. Do not do that.
Is it because you'll get taxed upon the sale of your house because it's even though it's your primary residence, but because you're claiming depreciation on a business, well, they're like, well, it's being used for commercial purposes.
They're going to say, like, who knows? The problem with taxes is it's very a political climate kind
That's
of
right.
expense.
Mm-hmm.
But no matter who is, leading our country, when you sell your house, that depreciation, they're still going to want the tax back on it.
That's
They're gonna
right.
they're gonna say, just like RSPs, we let you claim a little bit of tax savings throughout the years. Now
Mm-hmm.
we want it back.
That's right.
Mhm.
It's so true. It's really not, no such thing as a free lunch, except for the TFSAs, which we're really blessed to have.
Yeah.
Um,
Well,
so
and
yeah,
the
definitely.
thing about the TFSAs too is there's the caps on it. So it's a free
Yes,
lunch up to all these rules.
that's right.
Mhm.
Exactly. Exactly. Nonetheless, still a free lunch.
Still a free
Level playing.
lunch.
Yes, but for the most part, everywhere else, it's like no,
Well,
there's a
and same with education savings for kids. There's free lunches there too. I mean,
Mhm.
there's temptations all over the place.
Mhm. Yeah, you just got to know like how to take advantage of it and use it to
Mhm.
your benefit, and hopefully
Exactly.
not get dinged later too much.
Hmm.
And then finally, when it comes to filing taxes, so what happens when you don't file your taxes on time? Like, what's the worst case scenario? And I just want to really kind of emphasize this because in light of a lot of the scams out there where, if I had people call me and they were like kind of scared, like shitless because they're like, I got a call from CRA. They said I'm going to go to jail because I didn't pay my taxes. And I'm like, well, did you pay your taxes? She's like, no, I didn't. I'm like, okay, you're still not going to jail. I'm just wondering, like, what's causing you all this panic, right? So people are not aware, but I think it's very important that we kind of spread the word and just because there's so many like scammers out there posing as CRA people and threatening them with jail time, with heavy fines, getting arrested. So what is actually the worst case scenario if you don't file your taxes on time?
Okay, so I'm going to take two approaches here. If you owe and if you're getting a refund. So let's say, for example, I don't know what the date is today, the 20 something, but let's say April 30th comes and goes and you forgot, didn't have time, procrastinated, whatever. If you owed, CRA is going to say, you owed, you should have paid us. Just like any bill. You should have paid us, you didn't. Now we're going to charge you interest. And on top of that, there's a penalty that is a percentage of what you owed. So it's like, it's just added expense if you owe. If you were getting a refund, there's really no financial penalty in terms of a fee or interest or whatever. It's just you didn't get your money. And if you qualified for any of those government benefits, like if you have kids, they're not going to pay you your kid money.
Oh, okay.
So as Canadians, we get they change the name all the time, but it's like child tax benefit, or I just call it kid money. Everybody's entitled to it. And as long as your kids are under a certain age, they pay it on the 20th of every month. If you didn't pay your taxes, they don't know how much kid money to give you. So in July, they're not going to give you anything. So like, that's kind of another consequence, is you're missing out on some benefits as well as your refund.
Do they back pay? Like, let's just say you're a few months late and you file your taxes. You missed kid money for 2 months. Will they pay you back for that, or is it like, do you forego it because you paid?
They'll pay you back.
Okay, good. Okay, so that's good to know. There's really really the worst case scenario is if you're owing, then you just get paid. You just pay penalties and interest. No one's going to jail. No one's going to summon you to court. No one's going to show up at your house and arrest you and handcuff you and threaten you.
No, none of that.
That's right. Yeah, it's really good to know, because again, it's people get scared because they don't understand the actual consequences, which is why, like, it's it's great to like ask an expert and really see, like, just understand what the worst case is. So that's always comforting to know that you can't go to jail.
You can't go to jail. And like, CRA has a bad rap because for the most part, it's like, taxes are intimidating and there are the rules, and sometimes we don't want to follow the rules and all of those things. But if, for example, you get a huge tax bill that really you just can't afford, you can call CRA and talk to them, and they can set up some sort of forgiveness plan or something for you if you're in a special situation. So it's like, CRA isn't going to call you and tell you that you're going to jail. If you owed or something, they would say, you owed, what are we going to do? Let's make a plan, because they want their money. They don't want to send you to jail.
That's good to know. And it's true. Like, they're seen as like the tax man. They're like the big and scary and mean, and they just like want to like take your money and just no matter what the case is, right? But it's good to know that, if you do get stuck with a big bill at the end and you can't pay it, well, they have options for you. So they're trying to work with you, and not like they're really not trying to cripple you and like make you homeless kind of thing. So.
And I also feel like I'm sure a lot of the people listening to this, they aren't CRA employees, but sometimes you get a CRA person on the phone that isn't the friendliest person. Or maybe they're telling you their answer in a way that makes you feel uncomfortable. Just hang up and call back.
Get another rep.
Just get someone different, because you're calling there because you need help. And if the person is stressing you out, just hang up.
That's a good tip. That's so good to know.
Yeah. Because there are really good agents in there, and there are some, just like any establishment, there's people that make you feel good about it, and there's people that are like, that was the worst customer service I ever got. So just hang up.
Yeah. That's amazing. That's so good to know. It's a great tip. Yeah, so thank you so much for all of these questions. These are so helpful, and certainly I learned a lot that I didn't know, and I'm so glad I got these questions from the audience because again, everyone's situation is different, and you'll just never know if you end up being in one of these situations. So thank you so much for your time. So where can we find you, Meghan? Do you want to provide some information on how our audience can reach you and ask you any questions later or work with
Yeah.
you?
Absolutely. So I'm on all social media, Meghan Chomut, CFP, Facebook, Instagram, all the places. Um, in next week, I'm doing a challenge with my Facebook group where we are creating our one-page financial plan. So if anybody wants to dive deeper into the numbers and just get really nitty gritty on that, I would love to invite you to participate with us. And you to do that, you go to meganchomut.com/one-plan.
That sounds amazing. I'm definitely gonna sign up for that. That sounds amazing. So yes, I will post the links for everybody as well for anyone who wants to reach out to Meghan and definitely and follow her and sign up for that challenge. So
Awesome. Well,
thank
I look forward to meeting everybody in the group.
for sure. Thank you so much, Meghan.
Absolutely. Thanks for having me.
You're welcome.